The extraordinary events of the past 25 years, including major financial crises, the pandemic, and an unexpected surge in inflation, have profoundly tested and shaped monetary policy. Central banks rose to the challenge, but these events taught us much about what monetary policy can and cannot deliver. We draw 5 lessons. First, forceful monetary policy tightening can prevent the transition to a high inflation regime. Second, central bank asset purchases and lending operations can stabilize the financial system. Third, intense and prolonged monetary easing has limitations. Fourth, communication has become more complicated. And finally, foreign exchange intervention and macroprudential tools can complement monetary policy. These lessons point to key considerations for central banks. First, frameworks should be robust and fit for purpose regardless of changes in the environment. Second, there needs to be a realistic view of what monetary policy can deliver. Third, policies need to include safety margins or room for maneuver over successive cycles. Fourth, policies need to be nimble to best exploit that room for maneuver. And finally, there needs to be coherence across policy domains. In practice, this means that targets need to remain low to hardwire low inflation, that there needs to be greater tolerance for moderate, even if persistent, inflation shortfalls from target, and strong reactions to spikes, that monetary policy tools need to be deployed prudently, that central banks need to address heads-on the gap between what monetary policy is expected to deliver and what it can in fact deliver, and that strong safeguards are needed to protect central bank independence. The key message is that there are limits to what monetary policy can do. Sustainable growth and financial stability require a coherent framework in which other policies, prudential, fiscal, and structural, also play their part.